Hello and welcome to this video on public sector borrowing and debt. So public sector and borrowing and debt follow on from what we've looked at previously to do with fiscal policy. A reminder that fiscal policy is to do with government spending and taxation to achieve a government's macroeconomic objectives G and T, gin and tonic. In this video we're going to look at what is meant by the budget or fiscal deficit, the relationship between that and national debt, and then lastly the role of fiscal policy in stabilising the economy. So what is a budget or fiscal deficit? Well, that occurs when government spending is greater than tax revenue. So this chart here shows us the red line, government spending, and the blue line, government tax revenue. And the gap in any one particular year we describe as being the government's budget, or because it's to do with fiscal policy, the fiscal deficit. And there's been efforts in the UK over recent years to cut the deficit, reduce the difference between government spending and taxation. So some key terms for us. The first one is a budget deficit, and that is the gap between the amount the government spends and the amount it raises through tax. Now this is also the amount that the government has to borrow. If they haven't got enough money coming in and they're trying to spend more, then they need to borrow from other countries or from businesses or from individuals, and this all accumulates to form what is known as the national debt. So that is the total amount that government has borrowed through successive deficits. And one of the negatives of the national debt is that you have to pay it back eventually, plus interest. So we can have a look at the current situation, and the current UK government have a budget deficit, and they have done for a number of years. So the government has been spending more than it's received in taxation. And a current objective of government is to reduce this. So to raise tax rates or more likely cut government spending so that the government budget is balanced by the end of the decade. Whether this is likely or not, given Brexit, a lot of economists would say it's unlikely that will happen. Now, why it's important to balance the budget by the end of the decade is because the longer a budget deficit continues, the larger the debt that the government will accumulate. So the UK government now has debt that it needs to pay back of approximately, well, it's slightly more than this now, over £1.5 trillion. And they have to pay that back with interest. So there is current pressure to say we should reduce the national debt so that those interest payments are eliminated. Now let's look at the situation in Greece. And the people who operate out of this building have experienced some troubles recently in terms of government budgets that have been well publicised. This figure here shows us the Greek government's budget deficit as a percentage of GDP. And what we can see first up is throughout the whole period, 14 years here, we can see that there's been quite significant budget deficits. So if the Greek economy is 200 billion in size, a deficit of 10% means that government spending was 20 billion euros higher than tax revenues in that particular year. And we can see that there's been accumulation of budget deficits over quite a number of years. And one of the current Greek government targets is in the next couple of years to reach a surplus. Now, why has this been such a big problem? Well, as we know, government budget deficits contribute towards Greek government national debt. And we can see that there's been a substantial increase in Greek government national debt, nearly 350 billion euros worth, compared to the size of the economy, which is the blue line here, real GDP, which over recent years has seen a decline, a long period of recession and slump, and only just glimmering sign of recovery now. So the gap between what the government owes and the economy's ability to generate tax revenue to maintain that debt has dramatically diverged since the late 2000s. So this is quite a significant problem, and this final chart shows us the reason why. This is the Greek government's debt
compared to the size of the economy. And we can see here that Greek government debt is around about 180% of the size of the Greek economy. So the size or the value of everything that's produced in Greece within a year. And this is one of the highest values in the world. And we'll go on to explore this and why it's a problem in later topics.
Now, there are some arguments that actually a budget deficit and high national debt is not a problem. A rise in borrowing to fund extra government spending can have a big positive effect on aggregate demand and therefore GDP and employment, particularly when an economy is operating below full capacity. So this would be an argument why you should have a deficit. Often we would expect to have a deficit occur to cushion the fall in AD that is caused by an external economic shock. So for example, the fact we have had a recession recently and not a particularly strong recovery would suggest that actually there should be a budget deficit, government spending should be higher than taxation to get us back towards pre-recession levels. Another example would be that if you run a deficit now by spending lots of money, a fiscal stimulus, and you accumulate a deficit, in the long run that could help because as GDP grows in the future, this would lead to higher tax revenues and then the debt would also be smaller compared to the size of the economy. At the moment, interest rates are very low and it maybe would make sense for a government to run a deficit and to borrow when interest rates are low. So there are some arguments here why deficit is not a problem. On the flip side, there are some arguments that deficit and debt is a problem. High deficits cause rising debt interest repayments. And these are forecast to be about £50 billion in 2016, which is about half the education budget or maybe 40% of the NHS total budget. And this interest has an opportunity cost. What could that money be better else spent on? Also, an increase in national debt now in a deficit is likely to result in higher taxes in the future for that interest and debt to be paid back. So really we're just passing on the problem to future generations of taxpayers if we continue to have deficits and large debts now. So these would all be arguments why actually cutting the deficit and the debt should be a priority. Let's now look at the role of fiscal policy in stabilizing the economy. So let's imagine that this is the trade cycle in an economy without government. So GDP tends to go up and down over time through the four phases of the trade cycle. And this is without the government, so without the use of fiscal policy. Now, what fiscal policy can often do is smooth out the trade cycle so we have a smoother, less ups and downs, less of a cycle in GDP, and GDP growth is closer to the long-term trend. We don't have big booms and we don't have big recessions and slumps. Now, why might fiscal policy do this? Well, during the period of growth and boom, as economic activity increases, tax should be withdrawing money from the economy, and also there shouldn't be much government spending because everyone has jobs, there's less welfare payments required. So during this period, we would expect a budget surplus to be built up as taxes are greater than government spending. And this is a net withdrawal from the economy, so actually GDP would end up being slightly lower than if there was no government, because the net effect of the tax being higher than the government spending is that to withdraw from the economy and national income is lower. In periods of recession or slump, then the idea would be that the surplus that's been accumulated over here could then be used to increase government spending, and government spending would be rising because we need to pay more unemployment benefits, maybe more of a fiscal stimulus to help the economy recover, and also taxes would be falling as people lose their jobs, as incomes and profits go down, tax revenues will be falling. So we'd expect to be a budget deficit in this period, and that means a net injection into the economy. So government spending being bigger than taxation provides an injection, stimulating economic activity and actually meaning that the level of GDP would be higher than it would otherwise be without the use of fiscal policy. So fiscal policy can also sometimes be used to stabilize the trade cycle almost automatically through the use of government spending and tax. So to summarize automatic stabilizers, some forms of government spending and revenues and can automatically change in line with GDP and the state of the economy. So for example, progressive taxation will take out more money during periods of boom, and welfare payments will inject more money during periods of recession and slump. And this can help even out the trade cycle. And this gives rise to two types of budget deficit. The first one is a cyclical budget deficit. And that is where the budget deficit arises because the economy is in recession or slump. So at certain periods in time, we might expect a budget deficit because of the cycle within the economy. So we call these cyclical budget deficits. They're the ones that have been caused by the recession and where we use our previous surpluses. A budget deficit that has not been caused by changes in the trade cycle, we describe as being called a structural budget deficit. And that must be an intentional action by the government to spend more than they receive in tax. So for example, if the economy was growing and entering or nearing a boom phase in terms of the trade cycle, and there was a budget deficit, we would say that that budget deficit has not been caused by the trade cycle, it has been caused intentionally by the government, and we would describe that as a structural budget deficit. So in this video, we've looked at what is meant by a budget or fiscal deficit. We've looked at the relationship between budget deficits and national debt, and we've also looked at the role of fiscal policy in stabilizing the economy, called automatic fiscal stabilizers. That's it. Thanks very much.